Imagine trusting someone with your life savings, only to discover it's all gone, vanished into a web of lies. That's the devastating reality for victims of Ponzi schemes. Welcome to today's deep dive into one of the most infamous financial crimes in history, Ponzi schemes. From Bernie Madoff's shocking betrayal to schemes you may not have heard about, today we'll uncover how these schemes worked, who was affected, and the critical lessons we can learn to protect ourselves. By the end of this video, you'll be armed with knowledge to spot the warning signs of financial fraud. Let's dive in. Let's start with the basics. A Ponzi scheme is a type of investment scam where returns are paid to earlier investors using the capital from newer investors, rather than legitimate profits. These schemes rely on a constant influx of new participants to keep running. Once the pool of new investors dries up, the whole system collapses, leaving most participants with devastating losses. The term comes from Charles Ponzi, who orchestrated a notorious scam in the 1920s involving international reply coupons for postage. Ponzi claimed he had discovered a lucrative arbitrage opportunity that allowed him to buy postal coupons cheaply in one country and sell them for a higher price in another. He promised investors astonishing returns, 50% in just 45 days or 100% in 90 days. Initially, he gained the trust of many by paying early investors their promised returns using funds from newer investors. The scheme grew rapidly, attracting tens of thousands of participants and millions of dollars, an astronomical sum at the time. However, Ponzi never actually engaged in the arbitrage he claimed. As media scrutiny and government investigations intensified, the scheme unraveled. When it collapsed, it left countless people financially ruined and exposed the inherent unsustainability of such fraudulent operations. Ponzi schemes exploit basic human emotions like greed and trust. They promise extraordinary returns with little to no risk, drawing in individuals who are eager to believe they've found a way to achieve financial success. Understanding how these schemes operate is the first step toward recognizing and avoiding them. No discussion of Ponzi schemes is complete without mentioning Bernie Madoff. His fraudulent empire, uncovered in 2008, is the largest Ponzi scheme in history, and remains a chilling example of how trust can be manipulated for financial gain. Madoff lured investors with the promise of consistent, above-average returns through an investment strategy he called split-strike conversion. This strategy was presented as a sophisticated method of minimizing risk and maximizing returns by combining options trading with stock investments. In reality, no such trades occurred. Instead, Madoff fabricated account statements to create the illusion of profitability, using funds from new investors to pay returns to existing ones. Over $65 billion in paper wealth vanished when the scheme unraveled during the financial crisis of 2008. Many investors, already reeling from market losses, were completely blindsided by the collapse. Among his victims were small-time investors, celebrities, pension funds, and charitable organizations. Perhaps most devastating was the fact that Madoff's reputation as a trusted financial advisor and former NASDAQ chairman gave his clients a false sense of security. Investigations revealed that Madoff operated his scheme for decades, employing a vast network of enablers and using his legitimate brokerage firm as a front. His betrayal cut deeply, particularly for those who considered him a personal friend. Charities that entrusted him with endowments were forced to close their doors, and retirees who had invested their life savings faced financial ruin. The fallout of Madoff's scheme prompted widespread reforms in financial regulations and highlighted the critical need for investor vigilance. His actions teach us the importance of skepticism, even when dealing with seemingly reputable figures. The lessons from his fraud emphasize the necessity of being wary of consistent high returns, verifying investment opportunities with independent audits, and diversifying investments to minimize risk. Madoff's story serves as both a cautionary tale and a stark reminder of the potential consequences of unchecked greed and blind trust. While Bernie Madoff's scheme is the most infamous, other Ponzi schemes have wreaked havoc on unsuspecting investors. Alan Stanford's $7 billion fraud, for example, involved fraudulent certificates of deposit issued by his offshore bank in Antigua. Stanford's charisma and promise of unrealistically high returns lured thousands, including retirees, into investing their life savings. His victims discovered too late that the low-risk CDs were nothing more than a mirage. Another significant case is Tom Petters, who operated a $3.7 billion scheme centered around fictitious retail sales. By fabricating purchase orders, Petters convinced investors to fund his non-existent electronics business. The scheme persisted until an insider exposed it, leading to Petters's arrest and eventual conviction. Charles Ponzi, the man whose name became synonymous with these schemes, set the template in the 1920s. His promise of incredible returns on postage arbitrage drew in more than 30,000 investors, amassing millions of dollars before the scam collapsed. Despite its simplicity, Ponzi's scheme demonstrated how greed and trust can override skepticism. Reed Slatkin, co-founder of Earthlink, orchestrated a $600 million Ponzi scheme by targeting wealthy investors. Leveraging his reputation as a successful businessman, Slatkin gained their trust but ultimately left them with massive losses. These stories highlight a common thread: the exploitation of trust, reputation, and the lure of high returns. The financial devastation they caused underscores the importance of thorough due diligence and skepticism when evaluating investment opportunities. Ponzi schemes often succeed because they exploit human psychology and financial illiteracy. One of the most common warning signs is the promise of guaranteed high returns, especially in markets known for volatility. No legitimate investment can offer consistent, above-market returns without risk. Additionally, overly complex strategies that are difficult to understand or explain should raise suspicion. These schemes often rely on confusing jargon to deter investors from asking critical questions. Unregistered investments are another red flag. Legitimate investment opportunities are typically registered with financial authorities and subject to audits. A lack of clear documentation, such as audited financial statements, should be a major warning sign. Transparency is a hallmark of reputable investments, and the absence of it should prompt caution. Ponzi schemes frequently pressure participants to reinvest their returns instead of withdrawing funds. This tactic ensures the scheme's survival by keeping the capital within the system. If an investment advisor discourages you from withdrawing funds or penalizes withdrawals excessively, consider it a red flag. Finally, a reluctance or refusal to answer questions or provide clear explanations about how the investment generates returns should immediately set off alarms. Vigilance, skepticism, and a commitment to thorough research are the best defenses against falling victim to a Ponzi scheme. Beyond the financial losses, Ponzi schemes devastate lives in profound ways. Victims often lose their retirement funds, homes, and savings, leaving them financially destitute and struggling to rebuild their lives. The emotional toll can be just as severe. Many victims experience deep shame and embarrassment, blaming themselves for falling for the scheme. This often leads to isolation as individuals withdraw from their social circles, feeling a loss of trust in others and in financial systems at large. Charities and nonprofits are also frequent targets of Ponzi schemes, compounding the harm. When these organizations lose their endowments or operating funds, the impact reverberates through the communities they serve. Essential services such as food programs, educational initiatives, and healthcare support are disrupted, leaving vulnerable populations without the help they rely on. The ripple effects of a single Ponzi scheme can extend far beyond its direct victims, destabilizing entire communities and undermining public confidence in legitimate financial institutions. For those who perpetrate these schemes, the fallout includes criminal prosecution, lengthy prison sentences, and a permanent legacy of disgrace. Yet, no punishment can undo the widespread harm caused. This human cost underscores the importance of vigilance, education, and systemic safeguards to prevent such schemes from taking root in the first place. Protecting yourself from Ponzi schemes requires a combination of vigilance, education, and proactive measures. First and foremost, always verify the credentials of anyone offering investment opportunities. Legitimate financial advisors and firms will have proper licenses and be registered with regulatory authorities. Take the time to research thoroughly before committing to any investment. Look for reviews, verify claims with independent sources, and seek advice from trusted financial professionals. Diversifying your investments is another critical step. By spreading your assets across various asset classes and financial products, you can minimize the risk of losing everything to a single fraudulent scheme. Transparency is also key. Avoid investments that lack clear documentation, such as audited financial statements, or those that rely on complex jargon to obscure their operations. Legitimate investments are typically straightforward and provide detailed explanations about how returns are generated. Be skeptical of promises of high, consistent returns with little or no risk. No legitimate investment can offer guaranteed profits, especially in volatile markets. If something sounds too good to be true, it almost certainly is. Additionally, Pay attention to how returns are handled. If an advisor pressures you to reinvest earnings rather than allowing withdrawals, it could be a red flag. Trust your instincts and ask questions. A reputable investment professional will welcome your inquiries and provide clear, honest answers. Knowledge and awareness are your best defenses against fraud. Stay informed about common scams and learn to recognize their warning signs. Share this knowledge with friends and family to help protect them as well. By taking these steps, you can safeguard your financial future and contribute to a more transparent and trustworthy investment landscape. Ponzi schemes thrive on trust and the lure of quick profits. By staying informed and vigilant, you can protect yourself and your loved ones from becoming victims. Remember, if it sounds too good to be true, it probably is. Thanks for watching. Let me know in the comments if you've ever encountered a suspicious investment pitch or if there's another financial crime you'd like me to explore. Don't forget to like, subscribe, and hit the notification bell for more deep dives like this one. See you in the next video.